Hi everyone, Namaste. I'm Paramita Chatterjee from Deal Street Asia, and I welcome all of you here to our flagship Asia PVC Summit 2022. Well, I have with me some very prominent speakers from the VC landscape in India who will take us through the burning questions of today on the Indian economy, the funding landscape amidst geopolitical issues, the challenges in the exit markets, and so on and so forth. So without much ado, let's quickly welcome Mr. Sanjeev Bikhchandani, founder of InfoEdge India, which owns and operates India's largest online job portal, Naukri.com, and matrimonial site, Jeevan Sathi, amongst others. Now, just to give you a brief background about Sanjeev, well, he's a founder himself, an entrepreneur. He's also a venture capitalist. In fact, he was the first institutional investor of Zomato and Policy Bazaar that went on to become unicorns way later. Now, he recently founded InfoEdge Ventures to back early stage startups in India. Now we come to our second panelist, Mr. Sameer Brijvarma, Managing Director of Nexus Venture Partners. Now, Nexus is one of the first India-US venture funds that started operations in India in 2006. Now, to give you a brief background about Sameer now, he has funded over 70 startups in Nexus and has seen several successful cycles of investments and exits in the past. Amongst the portfolios that Nexus has backed, there are quite a few prominent unicorns as well. These include names like Delivery and An Academy. Now, the third panelist who we have is Mr. Mandar Dandekar, partner at Sorin Investments. Now, that's an early stage VC that has recently made the first close at 100 million. It's eyeing a total corpus of 130 million. And I believe they've kept a window of 18 months to make the final close. Now, Mandar has worked earlier with a couple of investment firms. These include Kalari Capital, which is a venture capital firm. He has also worked for Tata Capital Private Equity, Cognizant Technology Solutions, and Tata Power Company. Thank you all panelists. I appreciate your taking out time today to join us.
Thanks, Paramita.
Thank you, Paramita, for having us.
Thank you. I'll actually begin with a big picture question. There seems to be so much of uncertainty in the global market with, say, geopolitical issues, equity market correction, higher interest rates, higher inflation, all of them occurring in unison. Now, India, of course, is not isolated from it. So the one question that's weighing on everyone's mind amidst all of this is the slowdown in the Indian economy. So I would like to ask all of you this: how real is that, and how deep would the impact be? Sanjeev, if I can ask you to take this question, please.
So what we are witnessing in our business, all right, is for the last 5 quarters, we've grown 60% in Naukri YOY in revenue. Okay, the last 5 quarters. That is significant. The earlier quarters were of COVID impacted quarters, and therefore have been off very high growth quarters. Now, a lot of this has been driven by IT, and we saw the boom in IT. I think we saw it world over, that IT talent was in a very, very short supply. Obviously, it can't continue at this rate indefinitely, and there will be some cooling off in our business. And perhaps the next couple of quarters, will not be as high. But it's not as if there's a recession. It's there's growth. The non-IT sectors are picking up. So I expect that while growth will come off a bit, India will be better off than the rest of the world.
Right. So you mentioned a point about the non-IT sectors. Could you elaborate on which are the ones and what opportunity do you see?
I think the growth is fairly secular. Okay, most sectors are seeing growth. Whether it is insurance, whether it's telecom, whether it is travel, hospitality, whether it's financial services, we are seeing growth in most sectors.
Sure. Okay. So Mandar, do you want to add into that, given that yours is a firm that established its presence only this year? And of course, not to mention it's set up by some of the biggest names in the PE landscape, like Mr. Sanjay Nair, the ex-CEO of KKR. But what kind of impact do you think a weak global economy will have on the startup ecosystem in India?
See, I guess what we are seeing, and as you rightly said, we are actually just an 8-month-old firm, right? In terms of, say, setting this firm up. But all of us come with, say, prior experience in investing. We've just given a term sheet to a company. So we are in early stages of deploying in terms of having a portfolio of ourselves, but we have understanding of the portfolio from our previous organizations or the companies that we diligence for investing, right? What we are seeing is obviously for most of the businesses, the input costs are going up, right? And that's driven a lot by, say, supply chain issues, crude issues globally, which is a problem. So I think it's a phase which all of these companies will have to get over with, tackle, right? Find a solution for consumption to some extent. Even in India has been impacted a bit, but not to the extent what we are seeing in some of the developed economies. But I do believe that India will weather this much better than some of the other, say, economies in the world, right? So that way, I do agree that India is very rightly placed as compared to most of the other geographies.
Right. So one point that emerges from here is that the long-term growth story of India remains very much intact.
Yes.
I'll
Yes.
come to you, Sameer, on this. Well, Nexus has quite a few unicorns, in its portfolio, and some are also listed. So in general, stock markets are reacting to what's happening elsewhere. And we have seen share prices of many actually, listed unicorns falling after they've launched their IPO last year. So do you think that's prompting others to develop a cold feet in new listings? What, according to you, is the road ahead?
I would say, we went through a 13-year period of, monetary expansion policy, a lot of liquidity, and all of that is obviously changing with the Fed increasing rates. And they have very hawkish policy. Clearly, they are expecting to kind of bring rates up to about 4.5% in the next few quarters. That obviously has an impact in terms of how the world reacts to it, right? Obviously, the money supply is tightening in many ways, but knowing what you've seen through in many years and recessions and booms and busts, money will always chase growth. I agree with both Sanjeev and Mandar that India is really well positioned globally with a large consumption base, domestic consumption base, and of course, rapid good macros on the whole, with domestic macros. So I do feel that money is going to chase growth in good secular stories in sectors which are profitable. Last year was there was a lot of irrationality in the market. A lot of the global peers were overvalued, and a lot of the IPOs which got benchmarked to those were kind of priced in ways that led to kind of inflated valuations, and that led to obviously a lot of the retail investors as well as global mutual funds and some domestic mutual funds having exposure to these companies which didn't perform well. So that has developed cold feet in certain sectors. I would say in financial services or sort of fintech. I would say that unfortunately the Paytm IPO hasn't gone off well, so it has led to some issues there. But there are other sectors like insurance, other pieces in financial services where there will be very good demand for their IPOs, and there are a couple of them listed. So clearly the piece that is there is if the investors or the global investors see there's money left on the table and there are secular returns and it's a good story, profitable story, then people will be willing to kind of buy into some of these IPOs. But if they're overpriced with no money left on the table for then I think people will be very, very cautious. And that's what happened. All the IPOs, most of the IPOs last year got priced at the top of the range and had very little money for that. Because I think so if you're being more rational around how you take some of these companies public, and there's money left on the table for the investors, and there's a very strong story, strong economic model which is profitable at a unit basis, then I do think there will be demand for it. But there will be certain pockets like financial services, into sort of more fintech oriented, where there's been where I do see people be a little wary of investing into. So for some time, So.
Right. That seems to be some food for thought. Okay. So, clearly there seems to be a slowdown in deal making. Now, valuations have also come down both in public markets and in private space as well. So If I can ask you, what is the percentage drop in terms of valuation that you see in certain sectors? What would it be if you could give me a ballpark kind of figure?
This would be for me.
Any of you,
Okay.
Sameer, Mandar, maybe Sanjeev, yes, you can.
Look, in private space, it's very hard to sort of have a benchmark that this valuation was this much, now it is so much, right? Because those stocks are not traded every day, right? And you don't know what it was priced at last month, and therefore what is priced at this month, right? You do know people's expectations, and you do know that in many cases the founders' expectations are not being met in terms of valuation and perhaps even size of round, and sometimes even a round getting done, right? So, but there is enough money out there. Point is, investors are being discerning. They're being very discriminating. They're taking the time, right? This term sheet within 48 hours, that thing is over, right? By and large, right? So, this thing of following the herd is reduced as far as investors are concerned, right? You take your time. It's okay to miss a deal. It doesn't matter, according to me, right now. That's the mood. So you'll take your time. You'll be discerning. You will weigh the pros and cons. You will not go in as fast as you're going in earlier. You will negotiate harder on terms. You will give in less on some of the clauses. So to some extent, I would say the balance of power in the negotiation in the run-up to investing has shifted a bit towards the investor, the way it used to be before excess funding came in. I don't know, Sameer, if you agree with me, Mandar, if you agree with me.
I agree. Yeah,
I agree. Completely.
Principal is definitely more in favor of the investors now.
See, what we're seeing is that companies who raised during the last 12, 18 months and have enough cash in the bank, they are focusing more on unit economics, getting to profitability. So they are not out there to fundraise, right? But those who didn't do it in the last 12, 18 months, they have to fundraise. And now it's difficult for them to get the kind of round sizes they wanted, the valuations they wanted. Completely concur with what Sanjeev is saying. It's turning out to be an investor's market now, where investors are taking time, doing a lot of diligence, asking the right questions, the hard questions.
Right.
So, this is a FOMO in the investor's head that has reduced substantially. It's okay to miss out here, but we'll do the right deal.
Right. So you mentioned one point about, the days of 48 hours of a term sheet getting done. That's gone. So have you, any of you, this question is for all of you actually, have you seen any delay in sort of, closing the deal where you have gone back to renegotiate the valuation?
So we have not renegotiated ever because we think once you've given a term sheet, see, you want to live with the founder afterwards. If the founder believes he's being treated unfairly, right, and you've gone in, right, it doesn't make for a great relationship. So you thought the value was something in the intervening 2-3 months of diligence and paperwork, market corrected. As investors, info we live with that, right? And it's okay. I mean, if it's a good company, it'll grow to the valuation anyway.
Right. Sameer, Mandar, anything to add?
Yeah, I would agree with that. We as founders, and I'm sure like what Sanjeev mentioned, we are very, very, very careful about the repetition. Retrading, at early stages, when you have to work with the entrepreneur for many, many years, and when there's no, when you're coming in on good faith, that's where we generally come in. 85% of our investments are pre-revenue, pre-product, right? It's very important to set the right principles and right engagement model, right? So we rarely retrade. I would say we never retraded with companies, and I don't think that's a good thing to do. There is definitely a lot more time being taken for investments to happen. But I would just like to say that just this week I've been in a 48-hour situation where we've had to close in 48 hours, unfortunately, because it's a very, very high quality team. There will be exceptions, but it will not be the norm. So I've had to live with that scenario in this very week. So it is but on the whole, people are taking a lot more time to kind of focus on the basics, get the right questions, and do things like that. I would say the late stage guys, I would say the growth, people who are coming in, which are more like crossover funds, they had, I've seen certain situations where they have reached out to some of our portfolio companies that are open to, kind of retrading and marking things down and doing things like that, because they have a lot of pressure to kind of do a mark to market, and they see those prices in other balance sheets. Those global funds have that issue, and so I see some bit of retrading happening there if a company needs more money. But I think we're very lucky broadly that the ecosystem has lived through enormous amount of liquidity over the last 13 years, and a lot of the companies are very well capitalized and have, they can execute on plan mostly. So if a company is deep, doesn't have an economic model, is burning a lot of cash, and then it's a train wreck waiting to happen. They will definitely see a down round. So that is pretty sure, I would say.
Right. So in the early stage space, I'm curious to understand how a deal actually goes through. I mean, what are the parameters to check? Because, especially in pre-product stage companies, a lot of fundamentals are not there so much. And a lot of things, if I can use the word, also happen on the basis of speculation. So what are the parameters to check there to clock the right deal?
Look, I think at that stage, it is largely on the founding team's vision and their ability to sort of deliver what they are saying, right? Because you don't have too much of historical data. So it is more about the thought process, the future roadmap, the product that they're trying to build, how differentiated the product is, what they're trying to build today. Is there a differentiation, and how long-term that moat can be? And as the company scales, can that moat deepen? So that is one. Second is how large the market can be. If they are in an incumbent market, if there's a new business model or technology, is it a large market? Or if it's something new that they're doing, can they create, say, can this become a play in a very large market? And then three would be the technology or the product that they're coming up with in terms of adoption. Is there very low adoption friction in terms of their product or technology, right? Because you have a good product, but it needs to be adopted as well. So I think those are a few things that need to be looked at when at early stage, when it's pre-revenue, sometimes even pre-product, but largely pre-revenue, which you then have to make get a sense on what this can actually become.
Sure. Anybody wants to weigh in, Sanjeev or Sameer?
So look, at the early stage, you got to kick the tires enough to figure out if the thing is going to work. The team is important, but it's not just a team, right? So I'll tell you, when we went into Zomato, they were doing 1 lakh a month of revenue. Okay, but they had traffic, and the traffic was increasing without spending on marketing. So first straw in the wind, is it getting natural traction without advertising, without marketing? If it's getting natural traction, then maybe they're onto something, right? Small. But we figured that, look, it's a good team. They will pivot, they'll do something, and sometime in the future market will happen. And that's the way it worked out, right? We then look at, is it solving an unsolved problem? Is it unique and differentiated? And Zomato was at that stage. It was called Foodie then, but they had all the menu cards. They were the only site with all the menu cards. So somebody had taken the trouble going to every restaurant, picking up the menu card. Now, it's not that that's not replicable, but others didn't have it. And that was their secret sauce. And even when we announced that we love this feature, others didn't copy it. I don't know why. That was a big miss on the part of the others. Others did not have the menu cards. And then with that differentiation, they built on that, kept innovating. Mobile apps came, they got more and more restaurants, more and more cities all over India, and they began delivery eventually. So it worked out. And all of that was the founding team. So the founding team was dynamic enough to be able to take the early advantage and make something out of it. We invested in Policy Bazaar, pre-product, and definitely pre-revenue, pre-product. It was barely a PowerPoint. However, Yashish Dahiya produced compelling evidence that he was onto a value proposition that was really compelling. So he sat across my table in my office, and he said, "I'm willing to bet that your you're paying 60% more for your car insurance than you need to. I said, don't be daft. I bought the car from a dealer 3 years ago. I bought the insurance from him. I trust the guy. It's a public sector insurance company. What are you saying? Insurance is a standard product. He says insurance is a standard product, but pricing is not standard. And you don't know it because it's opaque and you don't go and check. So he said, take out your car insurance policy. So I had it in my drawer. So I took it out and I showed it to him. He said, okay, fine. And he did some querying in some database somewhere. And, within 20 minutes, he had 8 quotes from different insurance companies. The same car, same model, same year, same mileage, same everything. Same no claims bonus track record. And sure enough, the lowest quote was 40% lower than what I was paying. And he said insurance is sold, it's not bought, it's opaque, it's smoke and mirrors, people don't compare. Then in case you can't understand the fine print, and you don't even read it when you buy it, right? So, and I said, my God, if this is the kind of pricing differential there is across various service providers, right? This will work, right? So there was some compelling evidence that this value proposition is powerful. In Zomato, there was compelling evidence that there's natural traction, right? So obviously you use stuff like that. You don't go in blind. It's not a spray and pray. It's not a lottery. There is some method, some logic, and sometimes you get it wrong. Because when you go at that early stage, you get it wrong. And some you go very early. Yeah. What's your view?
Yeah, I think it really depends. I think in a lot of companies, especially consumer companies, there's a deep insight that the entrepreneur has. In many cases, that deep insight is actioned. Like in the case of Policybazaar, he had a query engine built in, or Foodie had the menus. In many cases, it's not an action, but they have a deep insight. But they have the ability that you can judge the person and decide whether there is they have the right traction channels and there is a pull in the product or whatever they will have. There's a sort of a value migration play which can be underway if what they plan to build will come through, right? So I think it really depends on. There are many companies that really funded, for example, which are absolutely, they were just people coming out. They had a unique insight. They had great work experience, or they hadn't even got down to building the product. They were just leaving their jobs and coming out. But they had a successful track record of delivering in highly unstructured, fast growth environments. And that was good enough proof with deep insights around how to change the particular industry or particular thing. And we've had good success partnering with some of those kind of entrepreneurs there, right? In the case of enterprise companies, which are SaaS or which are building from India out, typically most of the companies are just at PowerPoint level. But it again goes back to cumulative learnings. They would have had some bit of experience, some prior track record of delivering by which we would have partnered with them. So I think in 85% of the time, we are investing into pre-revenue, pre-product companies. It's selectively those 15%, where I would say 10% of those companies would be kind of where they have a product. As Sanjeev mentioned, there's initial love or whatever. There's some bit of pull. You can see that consumer behavior is changing, or the enterprise buying behavior is changing. So you can see some bit of that. But we are even more in the dark voodoo science space, I would say, where there is absolutely 85% of the time it's just 2 or 3 people probably serving their notices and doing their jobs, and we partner with them at that point of time, and they have a thesis around what they want to build, and we underwrite that thesis broadly with the ability that they have the agility. The founding team has the agility to build really strong teams around themselves. They have a prior track record of delivery. They can understand the market and keep evolving. And that's certainly where we come in and partner with these companies, right? We've done that multiple times, whether it's a Hasuda or a Tramix or a Postman or any of those things, right? Postman, for example, there was no company. It was just a free tool, which had some love, going back to Sanjeev's point, but there was no company around it. And we anchored the company, and they worked actually out of our Bangalore office for the first 6 months, putting the company and putting the team and everything together. So those are kind of examples. And on the consumer side, for example, Unacademy was a free YouTube channel. They didn't have an app when we funded them. We wrote the Series A. They was just had a free YouTube channel, and the idea was, can we build a product around it? At that point of time, There was nobody who was going to pay for it, for example, right? Nobody was paying for it. It was a free channel, and it wasn't clear that people would pay for it. But they made that transition because they had bundled value for the supply side and the demand side, and were able to execute from it. So it all comes down to people at the initial stages and throughout the life cycle of the company. It's all about people. That's what I would say. When you're summarizing my point here, you have to get that right, and the market, of course.
Right, absolutely. So you mentioned Unacademy. So there's so much happening in the edtech sector. Any thoughts on that?
No, I think it's a sector in the news for all the wrong reasons. Clearly, if you look at it, 2 years back when the pandemic started, Unacademy was still very early in its revenue. It grew probably 6.5 times from that time frame to get to its whatever 200-ish, little less than 200-ish million revenue run rate, right? So it grew really fast, and and it grew really fast because online education was the way in which people wanted to do that. We wanted to access this access classes. People are not going out to other cities for preparing for the tests and all of that kind of stuff. Right. And of course, a lot of that has changed now because things have opened up post-pandemic. People are going back to things. So in certain categories especially where there's 10th, 11th, 12th, certain categories people want to be studying offline, and there are these centers where people are going back to, whether that's in Kota, whether it's in their own local cities. So Unacademy has realized that trend very early, late last year, and this year, of course, went and established themselves in Kota, got the best educators, have gone offline, and are building a hybrid structure for doing this, where the core curriculum is done in centers, and the non-core curriculum can be done online. So it's a hybrid center. So it's a sort of a differentiated play in terms of how to do things. So all, as I said, entrepreneurs are not like this is all that I'm going to do, but they evolve based on customer needs, and they evolve based on what the market is telling them, and that's what the transition Unacademy made right now. So I think great entrepreneurs or great teams will keep evolving as to what the customer needs are, and things keep changing, and we are in a highly entropic environment in that sense.
Right. So I think talking about EdTech will, require a separate panel altogether, and another 40 minutes. So I'll go forward from here. We mentioned about, all of you actually mentioned about the slowdown in deal making in the sense that it's taking much longer. So how are LPs viewing the market in India currently in that kind of a scenario? Are they going to take more time to deploy the capital that they have committed to fund managers?
So look, we only have 2 LPs, Info and Temasek. And at least these 2 LPs have enough cash, and they're giving money on time. So speaking of myself, but we only have 2 LPs. So I don't know about the others.
See, even for us, like we're a new fund, but it's a good time to win, good vintage to deploy, right? So our LPs now. So we haven't heard anything from our LPs to go slow. In fact, they want us to make sure, as in, I wouldn't say aggressive, but take advantage of this right time to invest. And we've been fairly active in terms of evaluating deals, close to sort of in advanced stages of evaluating a lot of deals. So we haven't seen, again, I can speak only for myself, but we haven't seen any ask to slow down from our LPs at all.
I'll just add to that. You see, I keep telling people that our 2 best investments thus far, which is Zomato and Policybazaar, made in 2008, 2010, global financial crisis. That's the time we went in. And so you got the entry-level price, which was in hindsight very attractive. At that time looked excessive, but in hindsight very attractive. We got substantial chunks of the company for not that much capital in hindsight. And that really worked for us. So actually, you see, if early stage private market investing is a 8, 10, 12, 14 year sort of play, if you go in as a first check, right, and you wait till the IPO. And if you're talking about that kind of, life of an investment, or perhaps even longer, you really need to enter the right time, right price. Yeah. And therefore, when the market is down or corrected or slightly soft, it may be a better time to enter, actually. So it's counterintuitive, but that's what works.
Yeah.
Right.
Yeah, no, I agree. I agree with both what Mandar and Saji said here. I think LPs are very bullish on India on the whole. They have seen early signs of exits starting to happen in the capital markets, accepting most of the companies are going out. There's broad acceptance. There's a regime where there's M&A which is going to happen, consolidation. There are multiple exit opportunities. So I think on the whole, people are very bullish, at least based on all the LPs that we've been talking to. They are, and it's a great vintage to kind of invest, come in and do this early. We are mostly early stage investors, so we are going to continue doing whatever happens, whether boom or bust. We're going to be doing our 8 to 10 investments a year. So very, very disciplined around that, and we got to continue to kind of invest into the next, the next companies, which will be massive companies over the next decade. So we take a very different perspective, going into some of these companies, and we come in really early, right? So a lot of things need to be found at that point of time. I do see that LPs, there is a flight to quality in terms of the kind of funds that they want to invest into. So people who have an established track record, funds which have worked together, teams which have worked together through thick and thin, they have been able to catch the right, and they've been able to get multiple competences in different verticals, whether it's B2B, B2C, enterprise. So diversified large platforms, those are seeing a lot of interest, and LPs are very keen to partner with them. So those are going to get bigger. I would say the top 7-8 funds in the country, those will continue to be large funds and large platforms, and they're building diversified teams. The other part I would say is that there's an emergence of kind of specialist fund managers which are emerging, which are very, very thematic or very strong in a particular vertical. Those are also starting to see, quite a bit of LP interest, and LPs are looking for such fund managers in India. But I would say that funds which haven't been able to perform or haven't been able to diversify or haven't been able to evolve and have a good track record, or those are definitely having pressure, and they're not going to be able to raise the next one. So there will be a sort of a churn out which will happen at this point in time. The big will potentially get bigger and multifaceted in terms of their strategy. Specialist managers will emerge in certain sizes, stages, and things like that. But funds which haven't been able to perform well or been able to read the market well, those will get punished. I do see that happening.
Right. So considering that this is the right time for investors to clock deals because valuations are low and there's somewhat a slowdown and stuff, do you think it's also a catch-22 situation for investors? Because the ultimate aim is to exit, right, when valuations are high. So how do you plan to sort of balance both investment and exit objectives at this point in time?
See, I think
maybe I'll answer that.
Sorry,
go ahead, Manoj. Go ahead, Manoj. Okay, so
look at
just like.
Okay.
Go ahead, Manoj, go for it.
Okay. Look, I think when we come in at early stage, we look at it at least a 6-8 year kind of journey with the companies, right? So that's the journey that they have to traverse. So deploying now, which is a good vintage to deploy, these companies will grow over time. It will take 6-8 years for them to actually get to a stage where they become exit ready, right? And what the market, IPO market for tech has shown us that, yes, there is a market now. Yes, it was mispriced. And I think that's a learning for a lot of the people. That's a learning for the founders, for the investors, the investment bankers, everybody per se, which will correct, where everybody will get educated. So I guess in terms of balancing, it is a good time to invest now. As the things improve, things change, the exit cycle will come back again. And the companies that we invest right now, like I said, 6-8 years down the line, they would get to a stage where they become exit ready.
Just adding to what Mandar is saying, like, typically funds there, we raise funds in different, at every 2-3 years, right? We've been around, for example, we are in a 6th fund right now. We'll potentially raise the 7th fund hopefully soon. So, there are different vintages. We started out in 2008, starting deploying from that time frame. And, every 2-3 years, we've been investing into companies. And, when we raise a particular fund, we have a, 10-year horizon. The first 2-3 years of every fund are investing into early stage companies. And then a lot of those companies grow to be larger companies. So there's a good set of companies, if you look at it over the last 15 years, where we've had the opportunity to do either M&A or exits. So we've had about 18 exits now on the software side of things, right? We've had multiple IPOs. I think about 11 companies which have happened in other spaces. There've been M&As as well, and we've had about 5 or 6 IPOs. On the consumer side, or consumer or tech side of things. So we've been exiting companies as they get to a certain size of stage, and some cases there are M&As, some cases there are IPOs. So we've been able to do that, and a lot of the funds have been able to do that, and over the years. But that's how the fund business works. It takes the company that you invested in 2008, probably after 10 years, it's ready to be at a particular size and stage where it might be an IPO story, or potentially earlier in the journey, maybe 5 years in, it's got to a size and scale where it's ready for an M&A. And we work with the founders at that point of time, whether they want what they want to do, whether they want to build large enduring companies in that space, or do they feel it makes sense to be acquired. So we are always looking at it like that, and that's how the fund business typically works. And we'll always be looking, always at the same time, all investment professionals are entering companies and exiting companies once you are in the 4th, 5th fund, because that is the nature of the job. So you have to live in that duality in some ways.
Right. So which are the exit avenues that investors are cashing in on at this point in time? Clearly not the IPO market. So which are the other ones?
So I would say, I don't think it's not that IPOs can't happen at this point in time. We just did the delivery IPO, which has been very well received. This happened about 3 months back, and it's held up and gone up further. You left enough money on the table for investors. It's a very strong secular story, phenomenal team. Very fortunate to partner with them very early in their Series A. So I think we do feel that there will be opportunities. We have other companies which are filed confidential S1s in the US for going public as we speak. So it's not that we don't have companies in the mix which have gone public. Last year we took out PubMatic, we took out Clover. We had Kaltura. The 3 companies that go public from our stable in the last 18 months. So it's not that we haven't done that, but there would be 3 opportunities: IPOs for companies which are at scale, where the model is very well established and it has predictability in the model. The other one is M&A, and the third part is consolidation with larger platforms when the founders don't feel like they have been able to achieve the right sort of product market fit, or feel like it's better to be a part of a larger platform. So all 3 are open, and we let the founder decide all these things. We don't push them in any direction. It's the kind of company that they want to build, and we want to take all the companies IPO if we can, but it doesn't generally work out that way. I'll stop there, let the others add.
Right. Sanjeev, any thoughts on this, please?
So, see, my personal observation is that exits in India are hard, right? If you look at from inception to IPO, anything less than 10 years is really rapid, right? We took 9 years from inception to IPO. We were among the fastest, right? We took 6 years from our only round we raised. That was really fast. You look at MakeMyTrip, 10 years. Look at Just Dial, I think maybe 15, 18 years. You look at IndiaMart, maybe 20 years. Matrimony, maybe 20 years. So I don't know, Samir, from inception to IPO, what was Delivery's timeline?
It was 11 years.
So
10 and a half. It's 11 years.
So you see, that's the kind of time frame. Right now, the problem is that most VC funds are 8 plus 2 years, 10 plus 2 years. Right? So as an investor, let's say you invest in the second year of the fund, right? You got maybe 6 years left before the 8 years is over, because of plus 2 drilling extension, right? And then you start getting nervous, by the 6th year, because, exits take time. And you start those conversations. And strategic sales are not happening if you leave out Flipkart. They're not really happening at the kind of valuations within those 6-8 years that will make a VC investor really happy and allow him to get the kind of X that he was hoping to get, or he or she, right? And therefore, we have benefited from the fact that we did not have a fund initially. We were investing in the Info Edge balance sheet. So we went into Policy Bazaar in 2008 first, and we invested in the first 2-3 rounds. Then we did a minor exit, And then you went back in again in 2019. Now you can't do that as a fund. So 11 years out, you went in again. We've now been in there for 14 years, right? And we're still in there, right? A lot of the value in India sometimes will be made in the 12th, 13th, 15th year. You don't know.
Right.
Right. So you've got to think through this model as a VC industry. So we now have a VC fund, but we only 2 LPs, both of whom have proprietary capital. And it's a 12 plus 2-year fund. So 14 years. Right. So time horizon, I think, to exit in India is something which is really important. Or you don't go in as first institutional check. You go in, Series B onwards. Right. Then you can shorten the time horizon. So this is a point to ponder in my view. But I would love to hear Mandar and Samir's views on this observation of mine.
Yeah, I think Steve, very right. I think it's important, and we've also been thinking through this. So we have a 10+2 structure with our funds, and of course, one of the learnings is that it's important to have kind of the right kind of participants in the funds. Endowments, for example, make great partners because they have a very, very long-term horizon. So that's there. But when you have fund of funds investing in you, then the time horizon becomes very, very. There's a hard cutoff, and you can see value starting to compound and probably it's very tail-ended in many ways. After the 8th, 9th year, it was very clear that delivery is going to be a very, very massive company. But you don't want to be selling your gold at that point of time. So it's very, 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 very true. But having the right composition in the fund of LPs is also important to who can see the maturity of it. And a lot of them also, not in our case, but a lot of them are LPs. When you have the right set of mix, and with long-time horizons, they also buy out stakes and consolidate stakes from other LPs who might have a shorter time horizon. So we are starting to see that happen as well. But I absolutely agree with your point that having a long-term time horizon makes sense, which is what is happening with larger global funds. Also, there's a trend that once you have a phenomenally established track record, then you can go into an evergreen structure. And so that's the aspirational value for all funds because that's what's happening. Look at Figma. Figma took 10 years to exit, even in a tech story. 5 years there was no revenue, and then from the the 6th year onwards, it just started generating phenomenal set of revenue, right? So what do you do, right, in that situation when you're seeing something compound? So the sophisticated LPs really get it, and and track records of funds which are performed really well will move over a period of time with the right set of mix of endowments and long-term horizon, as well as with the evergreen structures. So we are starting to see that happen.
Right. No, absolutely. That's again, a huge food for thought. So on that note, we just have, very few minutes left. So any concluding remarks from all of you, about what you see about the opportunities to cash in on the investments, and so on and so forth. So Sanjeev, beginning with you, please.
Well, look, like I said earlier, the best time to go into a company, actually, when the market is a bit soft, the best time to go into a company is when you recognize and you see something that others don't see.
Sure.
Right? The best time to invest is to go today where the herd will go tomorrow. Don't follow the herd. Now, if you go in today and there's nobody else there, you'll get the deal you want and the terms you want. And the herd follows tomorrow. They'll get the follow-on rounds, they will get the valuation bid up, and you will be all right. We were solo for the first round, for the first 4 rounds in Zomato, just to tell you.
Sure. Mandar, concluding statements from you, please.
Yeah, I think from my end, look, the India story remains intact, and in fact, I would say it's becoming stronger and stronger. This correction was necessary, and it is good for the ecosystem. It's a good vintage to deploy for early stage funds. Partner with, say, the right founders who are solving real world problems, and be in their journey as they build, say, defining companies.
Sure. Samir, we come to you, please.
Yeah, I'll keep it short. I think the best is yet to come. I generally feel that I'm very, very bullish about India and what the next decade or a decade and a half hold for us. And in the ecosystem, I think all of us are going to be very, very fortunate to see this glorious run ahead. I'm very, very, very bullish. Both from a consumption standpoint, technology standpoint, as well as building from India for the world. Both these thesis, I think you're going to see some phenomenal companies getting created.
Sure. So I think that was an extremely in-depth discussion. And thank you so much for joining us once again. Really appreciate your sparing time. Thank you.
Thank you.
Thank you so much.
Thank you.
Thank you,
Thanks.
Sanjeev. Thank you,
Bye-bye.
Madhav.